It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of Bank Information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to Your Personal Bank Show. We had some fun a couple days ago. If you didn't hear Tuesday's show, and again, we're on every Tuesday at noon and Thursday at 1 on Money Radio. I'm going to really encourage you to go to yourpersonalbank.com and check out Tuesday's show. I did something, like I said, that's kind of fun. I probably should do it more often, but what I did is shared some of the famous stories of different folks that have used the Your Personal Bank tool, the high cash value policy, over the years, and how they used it, and really how it changed their financial future, frankly. And some of the examples I shared, I won't go into detail today. Like I said, go to the previous show to listen. But Ray Kroc with McDonald's, it's how he got McDonald's going. Walt Disney's how he got turned down by over 300 banks, and how he got Disneyland started. Bob Hope became multimillionaire as a producer using his personal bank and his cash value and his policy. Franklin Roosevelt. Most of his net worth was in high cash value policies. Sam Walton passed on a good chunk of his wealth tax free, and then part of the reason why they're still one of the most wealthy families out there. J.C. Penney saved and managed to keep Penney's open through the Great Depression as a result, and more recently, John McCain is how he funded his initial campaign financing for his presidential run in 2008. And then most recently was an example. I know the person personally involved with setting this up, and it's an ESPN article with Jim Harbaugh. It's Jim Harbaugh and Michigan agreed to increase compensation in form of life insurance. In other words, what they're explaining here in this article, if you want to check it out, or if you can contact us at yourpersonalbank.com, we'll have the article posted. You can check it out, pass it on, whatever. But it's an executive compensation plan, and this is the point that's it's commonly used in that arena, because again, when you have a key person, a highly compensated individual, a company or a business wants to keep that person on, they want to do the golden handcuffs. You may have heard that term. In other words, they want to keep that person on board, pay them a bonus, but make sure they stay. This is one of the financial tools that's very commonly used. And again, one of the main benefits to that key person is they can receive that income on a tax-favored basis. If you're already a high-income earner and you're one of the top tax brackets already, and getting a raise is nice, but if a third to half of it ends up going to state and federal income tax, is that exciting? Not as exciting as getting it basically tax-free, right? So that's why businesses use this quite commonly. And the Jim Harbaugh case is a great example of the University of Michigan using that for their head coach. So in keeping him on, giving him a raise, but not increasing his taxable income so much. You see what I mean? And creating a golden handcuff situation. So my point is, whether you're using it for a key person, you're using this to pass on assets in the next generation tax favored, or you're using it to grow wealth, or any other reason for that matter, this is a tool that works very well. It's not only works today, it's worked, I'm sharing examples that go back to the Great Depression nearly 100 years ago. So it's worked really well for a whole lot of people for the last century. So again, it's not a new idea. The other thing I want to share with you is kind of interesting. And again, just a quick refresher, what is Your Personal Bank? Again, for those who always remember, I have to share this because as the station always shares with me, there's new folks tuning in all the time. So if you've heard this before, I'll make it quick. But really, the Your Personal Bank concept is quite simple. We're using a bank tool with an insurance tool to create positive arbitrage. We're setting up a high cash value policy designed to grow cash, maximize cash growth, and we have companies that have been paying 6% dividends or more for the last 25 plus years and have never missed dividends since before the Civil War. They're fully capable of continuing to pay solid dividends going forward, have billions in cash reserves, A+ rated, all that good stuff. So you can get a nice solid return on your money consistently. And if we set it up correctly, we can do it all tax-free. So that ain't bad. And then to make it even better, we add the bank line of credit. The cash in the policy is the collateral for the line. There's no cost or fees for the loan. I was just talking to a client earlier this morning. Set up the bank line of credit, whether you plan to access funds or not. It doesn't matter. It doesn't cost you anything. But the beauty is when you do access the funds, you're getting charged in the threes. It's between 3 and 3.95 currently, depending on the amount of funds. And you're earning 6 plus. So if you're earning 6 and you're getting charged in the threes, what's happening to your money when you use it and spend it? It's still growing because what's happening? You're getting the difference. You're keeping the difference. You're making 2-3% positive arbitrage is what's happening. And if you look at the long-term history, that's one of the questions I get all the time. And these charts, I'll show you the dividend rates, payouts for the last 25 years of all the top dividend-paying companies. So you'll know exactly who you want to work with. Within minutes, you'll know. I'll show you the charts, and you'll see. It'll become abundantly obvious. And like I said, to do that, contact me at yourpersonalbank.com. I'll be happy to share that with you and show you which company you should use and why. And again, it'll be abundantly obvious to you and everyone else that's looking at it. The point is simple. If you leave the money in there and you're growing, you earn 6% tax-free, that ain't bad on a consistent basis with guarantees. Consistent, steady Eddie. When you access the funds through the bank line of credit, you're still picking up 2-3% positive arbitrage. So what does that mean? You're keeping the difference. Your money's still growing even though you're using it. To do what? Anything you want. How about supplementing retirement? How about paying off debt? How about investing in other assets? And now instead of getting 5% or 7% or 10% or whatever rate of return you're getting, how about adding 2 or 3% to that? You do realize if you're getting a 10% rate of return on an investment, which I think most people today would agree is pretty good, add 2 to 3% to that, what is happening? You literally are increasing your rate of return by 20 to 30% in that case. 20 to 30% increase is huge on rate of return, especially when you multiply that, add that over a period of time, over a period of years. That gets to be a massive difference. That's what we're talking about. That's what your personal bank does. When I say it enhances your financial future, I should say it dramatically enhances the financial future of most people I work with in a big way. Jim Harbaugh here is one of them. It's just an example of that, how a significant percentage of income now not going to taxes, but him actually getting to keep because he's using this tool makes a massive difference, okay? And this difference can apply to you in your life too, but you got to contact us at yourpersonalbank.com to learn more about how it can work and how it can work for you. The situation is, it doesn't, how it's going to work is different for everybody. There's not a cookie cutter type of, I can say, well, XYZ, you should do this. It comes down to your situation and your financial situation. And like I said, I don't have to I don't have to know every single little detail. But if I get a good general picture, an overview, we can put together a pretty darn good plan of what makes sense and how you can enhance the returns on your money using the personal bank concept. Okay? So stay tuned in the next segment. We're going to talk a little bit more about this Jim Harbaugh situation and then how it can apply to you in some other scenarios that can really enhance your financial future too. So stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back. Been talking a lot about different scenarios people are using the personal bank concept with. And like I said, we had a fun show on Tuesday sharing a lot of famous examples. I encourage you to go to yourpersonalbank.com and listen to the previously recorded shows. Listen to that one in particular. Because I do talk about, Ray Kroc and Bob Hope and Walt Disney and J.C. Penney and various examples of folks who have used this concept, used this tool in various ways, and to really help their business or their personal situation or pass on assets tax-free to the next generation. There's a lot of fun examples to share that are famous. And one of them I've been talking about, too, that I'm been much closer to is Jim Harbaugh, a head coach of Michigan in 2016. Michigan wanted to give him a bonus, increase in income, and they used a high cash value policy, this personal bank concept, to accomplish that. Basically, Michigan funded the policy. Jim can access the funds on a tax-favored basis What that does, of course, is reduce the overall taxable income for him, the way they structured it. That's done quite often with executive compensation or executive bonus plans. This is a tool that tax attorneys use regularly, okay? So it can be used. The thing is, it doesn't have to be an executive. They call it an executive bonus plan because that's where it's used probably most commonly. But what I want you to understand, and I tell this to folks all the time, add a zero or take away a zero. The principle works the same. So whether you're compensating yourself or you want a business to compensate you or pay a bonus to you in certain, and you have the situation where you can negotiate that, why not consider receiving your income tax-free versus taxable? If you want to learn more about how that works, contact me at yourpersonalbank.com. I have a gentleman, a client of mine working with, who is looking at that very situation as we speak, where he's going to be getting a nice salary income, but also with a nice bonus as a consultant for this new business startup, a rather large one, actually. And so we're talking about fairly significant numbers here. But the reality is, if he took all that income, he'd be, top tax bracket, no question, and have a lot of income tax. Why not mitigate some of that? And so that's what he's doing. That's what we're working on. So that's one of the tools, one of the uses or purposes of the high cash value policies and personal bank concept to accomplish those kinds of things. Another examples, or a few other examples, I guess I've worked with recently. I'll give you a perfect example here. I was working with this client last week because I'm kind of sharing some of these things. I've had some of my clients ask me and some of my listeners say, hey, can you share some more ideas of what you've seen work and what's been working and how people are using this? So here's a great example of somebody I worked with just this week who she's retired, has a fairly significant amount of money in various savings, online savings accounts and various things like that. And, with interest rates the way they've been going, these were high interest savings accounts. Well, we all know what's happened to those recently. The Federal Reserve has dropped rates tremendously. And so literally we were looking at these various different accounts, and all of them over the last several months have been dropping their rates to the point where really, literally, just about all those accounts at this point were under 1%. So what used to be a high-interest savings account where she would get 2-3% on it is now below 1%. And I'm seeing that everywhere. I'm seeing all over the place. So I was like, why not take – because I said, look, she goes, that's my cash reserves and all that. And I understand that. And I said, I get that. And she had a pretty good fair chunk that way. But the reality is this. You need to have cash reserves, absolutely. But no one ever said it had to be in the bank, in a savings account or money market or checking or whatever. In other words, your cash reserves just have to be safe and liquid. She goes, true. I said, what if you put it into a personal bank policy, a high cash value policy? She's going to have somewhere in the tune of about 85% liquid day one by putting the money in and having access to the bank line of credit. And here's the thing. Here was the kicker, and it just made total logic sense to her. It's just like this is she said this is such a no-brainer. If you put it in the policy, you get 6% dividends, which is a heck of a lot better than less than 1% in the bank savings account, obviously. But I said, even if you then access the funds and get charged, the bank line's in the 3s, so she's picking up 2-3% positive arbitrage, right? So even if you put it in the policy, then turned around, accessed it through the bank line, and spent the money, supplemented retirement, did whatever, she's still picking up between 2 and 3% positive arbitrage, which is more than double the return she's earning in these savings accounts. Just sitting there, doing nothing, basically, or next to nothing. They're benefiting the bank, certainly, but not her. And that's what we refer to oftentimes as we call dead dollars. These are dollars that are just kind of sitting there. They're kind of dead, not doing much. In her case, making less than 1%. You got to have some cash reserves for emergencies. I get that. She understands that. But again, nobody said it has to be in the bank. It just has to be safe and liquid. So this is money that's safe. It has guarantees. It's in, all that good stuff. And it's liquid, 85% liquidity day one. Within 3-4 years, she's at 100% liquidity. And she's making 6 times, 5-6 times more on the monies, 2-3 times more on the monies even after she spends it. She goes, well, this is kind of just, as she stated, this is just a no-brainer. I said, exactly. So that's another example that very recent of one I used to help somebody make a difference on their dead dollars. And it's funny. I guess it's not funny, but it's amazing how often I'll talk with somebody, meet with them. We start talking about their financial situation, the various accounts that they have and what's going on. And you'd be surprised, even shocked maybe, on how much and how often I find dead dollars, where people just have an account or several accounts where, like in her case, these savings accounts that were sitting there for emergency, they kind of grown over the years, grown to far more than what she needed for emergency, frankly, multiples of that, but just still kind of sitting there because, as she put it, she goes, I've been kind of looking for something, but I didn't know where else to go, didn't really want to put it at risk. She is retired, okay, which also is a common misconception. She even said, well, am I too old to set up the personal bank because I understand there's life insurance involved? And I said, no, not even close. She's in her mid-60s, and we've run the numbers already, and they look really good. And we're in the process of getting the case approved and going through, and looks really good. And her likelihood of getting approved and stuff, I would say, is probably well over 90%. And why not get 4, 5, 6 times return on your money, and even 2-3 times return on your money if you spend it? I mean, it's like she said, I'm quoting her, that's such a no-brainer. That's my point. Those are the kind of scenarios and situations I run into all the time. We're coming up on a break here pretty soon. I want to share some other thoughts and some other ideas on how I've seen people use this tool in the next segment. So I'm going to encourage you to stay tuned on this and if you do miss any of this show or any of the previous segments or shows, always go to yourpersonalbank.com. You can see it right up there. It's listen to our radio shows. You'll see it. It's very prominent. Can't miss it. And listen to any of the previously recorded shows. They have topics on all of them. Check out any of them that interest you. But like I said, stay tuned in the next segment. I'm going to share some more thoughts and ideas on how some of our clients have used the Your Personal Bank tool to enhance their personal finances.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, welcome back. We've been talking a lot about examples of folks that have used the personal bank concept, both famous and not so famous. In fact, Tuesday's show, we shared a bunch of famous examples. Everybody from, Walt Disney to J.C. Penney to Franklin Roosevelt to John McCain and everything in between. So if you missed that, go to the yourpersonalbank.com, listen to the previously recorded show. It'll say famous examples. Can't miss it. That was a fun show to do. We probably should share kind of those things more often than we do, because what it does is it does a couple of things. I mean, it illustrates different scenarios where, like, Sam Walton used it to pass on wealth to the next generation tax-favored basis. Bob Hope used it to grow wealth and ultimately become a multimillionaire when he became a movie producer, because this is where he used the funds to finance it. To business opportunities to start McDonald's or open Disneyland, things like that. But it also it shows the different opportunities and different ways this tool can be used. But it also illustrates how long it's been around, how well it's worked for so many people. I mean, I'm using examples that go back to, with Bob Hope and J.C. Penney, for example, that go back nearly a century. Helped J.C. Penney keep pennies open through the Great Depression, for example. It was the only funds he could access, and is the only way he could keep it going. The banks certainly weren't giving him any money. They didn't have any money to give. Okay, we saw that in the Great Recession, 08-09, where bank financing got really extremely tight and tough. We're seeing some of that now. I mean, if you've been paying attention to, like, trying to refi a mortgage, where the low interest rates are great, but the lending standards have tightened up considerably. Banks are concerned about what's going to happen in terms of going forward with when the moratoriums on mortgages and foreclosures and evictions expire. What's going to happen then? So what's happened is their banks are holding on to more cash, and they're tightening lending standards. It's getting harder and harder to qualify for a loan. You've got to have better credit, more money down, all those kinds of things. I'm not saying you're not going to be able to get a loan today, but it's definitely more difficult today than it was even a few months ago. That happens every time we see uncertainty in the market, in the economy, recessions, things like that, okay? So I don't want to get into the bad, but I just want you to understand when stuff happens, having that cash reserve, having the money there to take advantage of opportunities when they present themselves, like we talked about with Bob Hope or Ray Kroc or Walt Disney, or to take care of emergencies when they occur, like J.C. Penney, okay, keep pennies open through the Great Depression. It's a great example. Or to pass it on to the next generation, tax favored, like Sam Walton did, the Walton family. I mean, those are just great examples of how this can be used historically and, of course, today. So I've been sharing some ideas and thoughts from today, too. But I have one that literally yesterday, talking to a client, fairly long-time client, who set up several of these and set up the bank line of credit with it, for example. And their question was, asked me yesterday, and I talked to the bank about it, and they're like, yeah, this would work just fine. But they said, look, we've got a car loan. We want to pay off the car. It's 5% interest. And the bank lines of credit, are in the 3s. And this is an analogy. I said, well, let me show the story, and then I'll share the analogy. So they're like, well, could we set up another one of these? We have some cash. We want to set up another one of these, use the bank line of credit, and then pay off the car because the interest rate on the bank line is lower than the car loan. So discuss it with the bank. We can set up another one with the insurance company. Everything's fine. So this will be they have 4 of these policies currently with 2 different companies currently. And so this would be the 5th one for this couple. I've shared with folks many times, I own multiple of these policies. In fact, one of my mentors, last I checked, when I spoke to him a few months ago, he's been doing this 17, 18 years, and he's up to about 25 of these policies total among multiple companies. He owns them all. Now, he's not the insured on all of them. That's another point I'll make. He's insured family members, business associates, and all that stuff. But going back to this couple's example about paying off the car, it's really quite simple. The analogy I give folks is because really they set this up, get 6% dividends on it, access the funds in the 3s, use the money to pay off the car. What did they do? They wiped out the 5% interest on the car loan. They paid it off. And the funds they used are getting credited 6 and getting charged in the 3s. So they're still picking up 2-3% positive arbitrage. What happened? Literally in their situation, what's happening is instead of paying 5% on their car loan, they're now earning at least 2%. Folks, that's a 7% swing on your money. Guaranteed. Tax-free. Not bad. Okay? So my point is, by paying off debt, for example, that's just a smart way to do it. Analogy I use all the time, folks, is should I use the bank line or use other financing, things like that? I use this example. Let's say you decide you're going to buy a car. And you found the same car, same make, same model, same everything, same price at 2 different dealers. One's offering 5% financing and one's offering 3.5% financing. Well, which one you taking? Which one you choosing? Well, it's pretty obvious, right? You're going to take the lower cost financing. See, that's what the bank line of credit is all about, associated with the policy. You can take funds directly from the policy. And this is where a common misconception comes about often, okay? Most policies out there these days, some charge more, some charge less, but 5% is pretty much the standard. So using my example of the fixed Steady Eddie option we have right now, 6%, paying 6% dividends, has been paying 6% plus the last 25 years plus, never missed dividends since before the Civil War, okay? We've got multiple companies that have done that. But let's say you're making 6, you're getting credited 6, you get charged 5. You're still making 1% positive arbitrage with the policy without using anything else. You can do that. But the bank line comes in and you can get, your rates are 3 to 3.95. Again, depending on the amount and how we set it up. Well, do you want, when you access the funds to use them, do you want to get charged 3 in the 3s or 5%? That's a no-brainer. And if you're earning 6 on the money, remember all along, here's the key. Here's the difference. Here's the game changer. It's not that you're paying the interest like most people think out of as a loan. The money is still earning 6. If you use the bank line of credit, this is the clearest way to understand it. Most people get it. It clicks. When you access the funds, are you accessing the funds from the policy or the bank? You're accessing them from the bank. That means the cash is still in the policy. Remember, the cash is the collateral for the bank line of credit for the loan. The cash is still in the policy. Therefore, it's still earning its interest. And by the way, if we set it up on the fixed steady Eddy, it's earning 6 plus. Has for the last 25 plus years, as I've stated earlier. If we set it up in the index option, based on the S&P 500, it's going to make somewhere between 1 and 14% per year. That's the floor and the cap, just so you know. History, average, last 25 years, 8.5. That's averaged 8.5% interest over the last 25 years. I'll show you the numbers, show you what's happened. By the way, that's tax-free. Again, if we set it up correctly. I don't know, 8.5% consistent, or 8.5 average rate of return of the last 25 years, tax-free. Is anybody, are you going to be upset by, it's like, you can be happy with that rate of return? I would think so. Stay tuned in the next segment because I'm getting cut off here. I'm going to finish this thought in terms of really understanding how this works because I'm in the nitty-gritty of it right now to understand how you earn money even when you access it and spend it because you're picking up the difference, the positive arbitrage. So don't miss this. Stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, we're rounding third and wrapping this up, but right before the commercial break, I kind of I was in the middle of a thought, and I wasn't able to finish it, so I want to do that right now, because we've been talking about some fun examples, famous and not so famous examples of different ways of how the Your Personal Bank tool can work, how it can increase cash returns, how it can pay off debts, and how it can, increase your rate of return, pay off debt, still make money on your money, all that kind of good stuff. How you can pass on assets on a tax favor basis to the next generation. Both famous and non-famous examples. Again, if you missed it, go to yourpersonalbank.com. Listen to this show or Tuesday's show, famous examples, or any of the previous shows. It's worth doing. But here was the thought I was in the middle of, and I want to finish, and that was the gist, the nitty-gritty of how this works in terms of how this is different than pretty much any other financial tool that exists out there. Because remember, we've got a high cash value policy. The fixed option's paying 6% plus the last 25 years, currently still doing so. Plan to pay strong dividends, ongoing, tons of cash reserves. So 6% history, 25-year history plus, never missed a dividend since before the Civil War. Okay? Then we set up the bank line of credit, where the cash in the policy is the collateral for the line. There's no cost or fees for the line, and the line credits today are in the 3 to 3.95 range. Okay, so you're getting paid 6, you're getting charged in the 3s, you keep the difference. What's your money doing when you spend it? You're still making money. And again, to understand this, the key point is this: when you so I tell the people this all the time. You leave the money in there, get the 6%, or get the index option that's average 8.5% the last 25 years. Literally. You're going to get between 1 and 14% currently based on whatever the S&P does each year. And the historical average over the last 25 years is 8.5%. And if we set it up on a tax-free basis, 8.5% tax-free average, I think most people would be happy with. Okay? If we choose the fixed option, we got the 6. Okay? History, 25-year history of that plus. My point is simple. You put the money in the policy and it's earning the 6% dividends, or it's getting the index credits from the S&P 500, which again is average 8.5%. When you leave it alone, you let it grow and do its thing, it's pretty clear. It's obvious what it's doing. It's just growing, right? And we can set it up to grow on a tax-free basis. When you access the funds, did you take the money from the policy or did you take it from the bank? And the answer is it came from the bank. Because the funds came from the bank, the money in the policy is still there, right? Therefore, that money is still earning the dividends of 6% or the S&P index credits, somewhere between 1 and 14, historical average 8.5 over the last 25 years. So you're earning the 6 or 8.5, okay? Now, the bank's going to charge interest on that line, of course. And the rates they're charging are it's prime, by the way. Prime minus a half is the normal rates, currently in the range of 3 to 3.95. The banks have floors. If you're earning 6 and you're getting charged in the 3s, when you spend the money, you used it elsewhere, what's your money doing? Still growing. You're keeping the difference. The difference is the positive arbitrage. And the difference on the fixed account is 2-3%. The historical average difference on the index is 4 or 5%. How would you like to make 2, 3, even 4 or 5% on your money after you spend it? After you spend it to supplement retirement, after you spend it to pay off a debt or a bill, or after you spend it to invest in another asset to get a return. Because here's the difference. You're not thinking about, should I invest in this or that? Should I invest my money here or that other asset? You're not comparing rate of return of some other asset, market or real estate or whatever it may be, versus this. What you're doing is you're getting your rate of return on your asset, your investment, whatever that is, and you're adding 2 or 3 or 4 or 5% to your ROI, to your rate of return. You see what I'm saying? You're increasing your overall rate of return. And I've often said this. I've said this many, many times. If your rate of return on an asset is 10% annual average, again, I think most people would be pretty happy with that. And you increase it by just 2-3%. Not even thinking about the index where you could increase it 4 or 5%, historically average. If you increase it by 2 or 3%, you've just increased your rate of return by 20 or 30%. I mean, if you're looking at a portfolio, you're looking at 2 portfolios, you've got 2 proposals, and looking at investing your money in. And one of them you're fairly confident you're going to get an average of 7% return on. And the other portfolio looks good to you that you're pretty confident you're going to average a 9 or 10% return on. Same risk tolerance, same everything. Which portfolio are you going to go with? I mean, it's pretty obvious. We're talking about the same investment, right? If you can pick up an extra 20 or 30% or more return on your money, wouldn't that be worth looking into? And that's what Your Personal Bank does. That's what this financial tool does today. And like my stories and we've been sharing about both famous and not so famous examples over the last 100 years, literally, it's been doing this for all that time, for all those people. Why not take a look at it for yourself? Why not consider it as part of your portfolio? Why not consider adding this tool to your financial tool belt so that you can increase returns on your monies, for example, or at least earn some interest on money you spent? Wouldn't that put more money in your pocket? And I'm not even talking about how we could probably reduce some tax situations for you, increase some liquidity. I haven't even mentioned the living benefits like long-term care benefits that are involved that are built in at no additional cost. You know, that's huge, okay, for a lot of people. You can have basically medical severe, chronic, long-term care type of benefits without any additional out-of-pocket. Okay? All this is built, and don't forget, there is a death benefit. So if we have a couple, for example, his and hers, we typically like to do that. That way, if something happens prematurely to one of the parties, the survivor gets a nice check to help supplement loss of income, Social Security income, or whatever that may be. My point is simple. There's a lot of reasons behind doing it, but the number one reason people typically initially look at it is for diversification, enhanced returns, reduced taxes, increased liquidity. And like I said, with all these stories we've been sharing, this is not new. This has been working for a lot of people for literally over a century. Continues to work today. Check out some of the examples. Go to yourpersonalbank.com. Contact us for more information. Let us go over the situation for you. Share with you. I can share with you how this can work for you. And all I really need is a basic snapshot of your financial picture. Talk to you a little bit about what your goals are, what you want to accomplish, where do you want to be, and we can show you how your personal bank can help you accomplish those things, get you there, and not only that, but get you there most likely quicker, more efficiently, grow your money faster, pay less in taxes, and have more money available to use and spend in your lifetime. And isn't that the point? Isn't that what we want our money to do for us? As always, stay tuned to the Your Personal Bank Show on Money Radio, 1510 AM or 105.3 FM. We're on every Tuesday at noon or Thursday at 1, or go to yourpersonalbank.com. We'll talk to you next week.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.